You probably found yourself in this position lately. It's late at night, and you're scrolling through real estate listings on your phone. You see a house that looks, frankly, quite ordinary. It has the standard beige siding, a kitchen that hasn't been updated since the early 2000s, and a patch of grass that barely qualifies as a yard. Then you look at the price tag, and it hits you like a physical weight, $500,000. Your mind immediately starts racing, trying to figure out how a house that looks so starter level could possibly cost $500,000. You start wondering if you missed a major memo about the economy or if you're just not working hard enough. But here is the truth that the housing industry doesn't want you to internalize. It isn't a personal failure of your work ethic, it is a fundamental failure of the math. In this video, we aren't going to talk about what a bank says you can qualify for because the bank's interests are not aligned with your happiness. We are going to look at the cold, hard numbers of what it actually takes to live in a $500,000 home today without turning your entire life into a high-stakes survival game. There is a massive, dangerous gap between being able to sign a mortgage document and being able to actually sleep through the night without financial anxiety. The mirage of the standard home. To understand why we are here, we have to look at what $500,000 actually buys you in today's market. In cities that are even remotely close to job hubs, places like Austin, Denver, or the outer rings of major coastal metros, that $500,000 price point is no longer the luxury tier. It is the baseline. It's the cost of a 1,200 square foot box with 3 bedrooms and a postage stamp-sized yard. This is what is now being marketed to the average family as a normal entry point. The problem is that the income of the average family hasn't kept pace with this reality. The median household in this country brings in about $84,000 a year. When you compare that to a $500,000 house, you realize we are asking families to buy homes that cost 6 times their annual salary. If that feels like a recipe for disaster, it's because it is. Yet every corner of the industry is whispering in your ear that you should just make it work. Your mortgage broker gives you a thumbs up, your parents tell you that real estate is always a win, and social media influencers show you how to hack the system with no money down. But they are ignoring the reality of the numbers, the down payment mountain. Let's look at the first massive hurdle, the down payment. For decades, the gold standard was putting 20% down. On a $500,000 home, that is a cool one, $100,000 in liquid cash. When you consider that the average American savings account holds about $8,000, you realize the average person isn't just a little short. They are nearly $92,000 short of that goal. Think about the discipline required to save that much. If you are a high achiever making $84,000 and you somehow manage to save 10% of your gross income, which is incredibly difficult when rent and groceries are spiking, it would still take you over 12 years to save that $100,000. And here is the kicker. By the time those 12 years are up, that $500,000 house will likely cost $750,000 or more. You are chasing a finish line that is bolted to a rocket ship. Because of this, most people choose the shortcut. They put down 5% or 10%. But this choice comes with a hidden poverty tax known as private mortgage insurance, or PMI. This is a monthly fee you pay to protect the bank in case you fail, and it does absolutely nothing for you. It can cost you anywhere from $200 to $400 every single month, just for the privilege of not having $100,000 in the bank. The iceberg of ownership. When people look at a mortgage calculator, they usually only look at the principal and interest line. If you put 10% down, $50,000, you're left with a $450,000 loan. At current interest rates, which are hovering between 6% and 7%, your base payment is roughly $2,800 a month. For many, that already feels like the limit. But that $2,800 is just the tip of the iceberg. Once you move in, the invisible costs of homeownership begin to surface. First, there are property taxes. Depending on your zip code, you could be looking at an additional $500 a month just for the right to exist on your land. Then there is homeowners insurance. With the rise in extreme weather and the general cost of construction, Insurance premiums have gone through the roof, often adding another $300 to your monthly bill. And then there is the entropy tax, the cost of things breaking. A house is a complex machine that is constantly trying to return to the earth. The standard rule of thumb is to budget 1% of the home's value every year for maintenance. On a $500,000 house, that is $5,000 a year or about $417 a month. You might not spend it every month, but you will certainly spend it when the water heater gives up or the roof starts leaking. When you add up the mortgage, the PMI, the taxes, the insurance, and the maintenance, that affordable $2,800 payment has ballooned into a $4,367 monthly commitment. This assumes you don't have an HOA fee or any major emergencies. The math of the financial straitjacket. Now, let's talk about who can actually afford that $4,367. Conventional financial wisdom says you shouldn't spend more than 28% of your gross income on housing. If we apply that rule to this $500,000 house, your household needs to be earning roughly $187,000 a year. Even if you use the bank's more aggressive danger zone limit of 43% total debt to income, you still need to make about $150,000 a year. Here is the sobering truth. Only about 10% to 20% of households in the United States earn $150,000 or more. This means that the vast majority of people, roughly 80% of the population, cannot comfortably afford what is currently considered a normal home. This isn't an opinion or a pessimistic outlook. It is simply math being cruel. People are still buying these houses, but they are doing it by stretching themselves to the breaking point. They are one job loss, one medical emergency, or one major car repair away from total financial collapse. The successful couples struggle. To see how this plays out in the real world, let's look at a hypothetical couple we will call Sarah and Mike. They are both professionals with a combined income of $160,000. By almost any standard, they are successful high earners. But let's look at their bank account after they buy that $500,000 home. Their $160,000 gross salary sounds great, but after federal and state taxes, Social Security, and a modest contribution to their 401ks, their take-home pay is closer to $9,500 a month. Now, subtract that $4,367 housing cost, they are left with about $5,100 to cover every other aspect of their lives. Since they probably live in the suburbs to afford this house, they likely need 2 cars. Between car payments, insurance, and gas, there goes another $1,350. Then you have student loans, the very things that allowed them to get these high-paying jobs, which might take another $600. Adding groceries for a family, $800. Health insurance premiums, $400, and utilities for a large house, $450, and suddenly they only have $1,500 left for the month. That $1,500 has to cover everything else: clothes, birthday gifts, medical copays, home repairs, and the occasional night out so they don't lose their minds. This wealthy couple is actually spending nearly 50% of their take-home pay just on their house. They aren't living a life of luxury. They are living in a state of constant, low-grade panic. The psychological toll of the house poor life. This is what it actually feels like to be house poor. It's the feeling of lying awake at 2 a.m., doing mental math to see if you can afford new tires this month, or if you have to risk driving on bold ones for another 8 weeks. It's the anxiety of checking your balance at the grocery store. It's the guilt of having to tell your kids they can't go on a field trip because that $40 is actually earmarked for the emergency fund that you haven't been able to grow in months. When you are this stretched, every minor inconvenience becomes a full-blown crisis. If the HVAC breaks and the repair bill is $5,000, you don't have it. You put it on a high-interest credit card, which only makes your monthly burden heavier. You become a prisoner in your own home, working a job you might dislike because you cannot afford even a single week of lost income. The broken incentive structure. Why aren't more people talking about this? Because the entire housing industry is designed to get you into the house, not to ensure you can thrive there. The bank They want the interest on a 30-year loan. As long as you don't default immediately, they are happy. The real estate agent, their commission is a percentage of the sale price. They have zero incentive to tell you a house is too expensive for your budget. The system, we have collectively rebranded financial desperation as adulting. We tell people that eating ramen and having no furniture is just a rite of passage for homeowners, rather than a sign that the market is broken. We are constantly told that renting is throwing money away, but we rarely talk about how being unable to afford your mortgage is also throwing money away, just with the added risk of a destroyed credit score and the loss of your down payment. A structural reality check. The math of the American dream has fundamentally shifted. Since 1990, home prices have skyrocketed by roughly 400%, while median household incomes have only increased by about 180%. The relationship between what we earn and what it costs to live has become completely disconnected. You cannot budget your way out of a structural affordability crisis. You can skip all the avocado toast and fancy lattes you want, but that isn't going to bridge the gap between a $160,000 income and a market that demands $190,000 for stability. The power of saying no. So, what is the solution? It starts with giving yourself permission to stop playing a rigged game. There is no trophy for owning a home that makes you miserable. There is no shame in acknowledging that in today's market, a $500,000 house is a luxury item that requires a high-tier income to sustain. If your household income is under $140,000, looking at a $500,000 house isn't just a stretch. It is a decision that could dominate and potentially derail your financial life for the next decade. Instead of following the crowd into a financial straitjacket, consider the alternatives. Keep renting. This allows you to keep your margin and invest your surplus cash into the stock market or other assets that don't leak or need new roofs. Look for a small win. Consider a much cheaper home, even if it means a longer commute or a less trendy neighborhood. Relocate. If your current market is fundamentally broken, it might be time to look for a location where your income actually has purchasing power. Redefining wealth. Real wealth isn't found in the equity of a house you can't afford to maintain. Real wealth is margin. It is the freedom to lose a job and not lose your home. It is the ability to contribute to your retirement and fix your car without checking your bank balance in a cold sweat. The bank's calculation of risk is not the same as your calculation of life. The bank cares about whether the loan will be paid. You should care about whether you will be happy. Don't let social pressure or a perfect kitchen drive you into a life of quiet desperation. The smartest financial move you can make is to be the one person in the room who is willing to do the math and walk away when the numbers don't add up. Because at the end of the day, the goal isn't just to own a set of keys, it's to own your life. If the game is rigged, the only way to win is to choose not to play by their rules. Wait for a better opportunity, build your margin, and make your decisions based on reality, not the new normal. Subscribe for more videos.